Stop what you're doing right now, this instant. I don't care if you're in the middle of breakfast. I don't care if you're getting ready for work. I don't care if you just sat down to relax. What happened in the last 24 hours in global financial markets is so significant, so unprecedented, so potentially catastrophic that if you don't understand this in the next 15 minutes, you're going to wake up next week and realize you completely missed the warning signs of what could be the biggest market collapse of 2026. Ladies and gentlemen, the Metal Guy here. Today is Monday, January 19th, 2026. And we need to talk about what happened over the weekend. What happened to stock futures overnight? What happened to European markets this morning? And what's going to happen when American markets open tomorrow after being closed today for the Martin Luther King Jr. holiday? Because while most Americans were enjoying their long weekend, while traders were off duty, while the financial media was on autopilot, a bomb went off in global markets, and the shockwave is still spreading. Here are the facts. According to verified financial reports from multiple major news outlets, U.S. stock futures crashed overnight. The S&P 500 futures fell 1.1%. The NASDAQ 100 futures plunged 1.4%. The Dow Jones Industrial Average futures dropped 0.8%. And it's not just America. European markets got absolutely hammered. Luxury stocks crashed. Automakers crashed. Sectors exposed to American trade got destroyed. Credit risk gauges spiked. Bond yields moved. The dollar weakened. The Swiss franc, a traditional safe haven currency, surged as investors fled to safety. And gold just hit a fresh all-time record high of $4,673 per ounce. That's higher than we've ever seen in human history. The yellow metal is screaming that something is fundamentally broken in the global financial system. So what triggered this? What caused futures to crash? What spooked markets so badly that gold spiked to records while stocks plunged? One announcement, one statement, one threat from the administration over the weekend. According to verified reports, the president announced Saturday that he would charge a 10% import tax starting in February on goods from 8 European countries. Which countries? Denmark, Norway, Sweden, France, Germany, the United Kingdom, the Netherlands, and Finland. And the reason? These countries oppose American efforts to take control of Greenland, the semi-autonomous territory that's currently part of Denmark. That's it. That's what crashed global markets. A threat to impose tariffs on 8 of America's closest allies because they don't support a territorial expansion plan. Now, before you dismiss this as just another political drama, before you think this is temporary noise that'll blow over, let me show you why this is different. Let me show you why this matters. Let me prove to you that what we're witnessing is the beginning of a trade war that could destroy the global economy. First, let me give you the verified timeline of events, because understanding how this unfolded is critical to understanding why markets reacted so violently. According to multiple news sources, on Saturday, January 17th, the president made the announcement. He stated that starting February 1st, 2026, he would impose a 10% tariff on imports from the 8 European nations. And if they don't agree to a deal allowing Washington to buy Greenland, the tariff would increase to 25% by June 1st, 2026. Let me repeat that. A 10% tariff starting February 1st, escalating to 25% by June 1st, on 8 European countries, America's NATO allies, some of the largest economies on Earth. On Sunday, January 18th, the targeted European countries responded. According to verified reports, Denmark, Norway, Sweden, France, Germany, the United Kingdom, the Netherlands, and Finland issued an unusually strong joint statement. They said the threat undermines transatlantic relations and risks a dangerous downward spiral. This was described as the most forceful rebuke from European allies in recent memory. These aren't random countries complaining. These are America's closest partners, publicly stating that the relationship is being undermined. Then, on Monday, January 19th, markets opened in Asia and Europe, and they crashed. According to verified market data, Asian markets showed immediate stress. European markets opened sharply lower. U.S. futures, trading overnight while American markets were closed for the holiday, plunged. Germany's DAX fell 1.1% initially, closing down 1.3%. France's CAC 40 shed 1.3% at open, ending down 1.9%. The Stoxx Europe 600, Europe's benchmark index, fell 1.2%. Its worst session in 2 months. According to verified reports, sectors most exposed to the American market took the heaviest losses. Automakers crashed. Luxury goods companies plummeted. These are companies that export heavily to the United States. And they're now facing the prospect of 10% to 25% tariffs, making their products more expensive and less competitive in the American market. Meanwhile, according to financial data, defensive sectors outperformed. Telecommunications held up. Defense stocks actually surged on the heightened geopolitical tension. Gold spiked to 4,753, a fresh all-time high. The Swiss franc strengthened as investors fled to safety. This isn't normal market volatility. This is a risk-off panic. This is capital fleeing stocks and flooding into safe havens. This is exactly what happens at the beginning of major market crashes. Now, let me explain why this Greenland tariff threat is so much more dangerous than previous tariff announcements. Because the administration has threatened tariffs before. We've heard about tariffs on China, on Mexico, on Canada. So why is this one different? Here's the critical difference. This isn't about trade imbalances. This isn't about protecting American industries. This isn't about national security concerns over supply chains. This is about territorial expansion. This is tariffs being used as a weapon to force sovereign nations to accept American control over Greenland. That's unprecedented. That crosses a line that hasn't been crossed in modern international relations. According to verified reports, the European Union is now in talks to potentially impose retaliatory tariffs on $108 billion worth of American goods. $108 billion. That's not a small number. That's a massive escalation. And here's where it gets terrifying. According to analysis from a major investment firm, a 10% U.S. tariff on these 8 countries would lower real GDP by 0.1% to 0.2% across the affected nations via reduced trade. Germany would get the biggest hit, but the analysts added this critical warning. The hit could be larger should there be adverse confidence or financial market effects. That's code. That's economists speak for. If this triggers a panic, the damage could be catastrophic. And we're already seeing the confidence effects. According to another analysis, a Greenland-driven escalation in the U.S.-Europe trade war could erase most European earnings growth in 2026. The analyst added, this may trigger a mid-single-digit correction. Translation, European stocks could fall 5% to 7% if this escalates. And remember, European markets are interconnected with American markets. When Europe falls, America follows. When both fall together, global markets collapse. Now let me show you why the timing of this makes it exponentially more dangerous. Because this isn't happening in a vacuum. This is happening in the context of an already fragile global economy. According to verified data we've discussed in previous videos, the U.S. national debt just hit $38.4 trillion. The government is paying over $1 trillion per year just in interest. The fiscal deficit is 5% to 7% of GDP. Peacetime deficit spending at wartime levels. The financial system is highly leveraged. According to previous analysis, the world's largest asset manager has gone underweight on long-term treasuries because they see fiscal risk. Major institutions are reducing exposure to dollar-denominated debt. The silver market is in a structural deficit of 230 million ounces. Exchange vaults have been drained of 70% of their inventory since 2020. Industrial metals are signaling supply shortages. And now, on top of all of this, the administration is threatening a trade war with 8 European allies over Greenland. It's like the economy is a patient in intensive care, barely stable, and someone just decided to shake the hospital bed violently. The system can't handle another shock. The leverage is too high, the debt is too large, the deficits are too structural, and now we're adding geopolitical risk and trade war escalation to the mix. Let me show you what happened to specific asset classes overnight. Because the details matter, the specifics tell you where the smart money is positioned. Equities. According to verified data, S&P 500 futures fell 1.1%. NASDAQ 100 futures sank 1.4%. Dow futures dropped 0.8%. European stocks fell even harder. Germany down 1.3%, France down 1.9%, stocks 600 down 1.2%. Gold, according to market reports, gold topped $4,660 per ounce overnight, then pushed even higher to $4,173, a fresh all-time record. Currency. According to verified data, the US dollar dipped 0.3% as the Swiss franc outperformed. The Swiss franc is what investors buy when they are terrified. It's the ultimate safe haven. When the franc surges, it means capital is fleeing risk. Bonds. According to financial reports, short-dated government bonds led gains with the German 2-year yield falling as much as 4 basis points to 2.07%. U.S. Treasury futures slipped, implying a 2 basis point increase in the 10-year yield. Investors were buying European bonds and selling U.S. bonds, a sign of stress in the transatlantic relationship. Credit markets. According to verified data, gauges of European credit risk rose. The iTraxx crossover index of junk-rated credit default swaps, a key gauge of risk sentiment, rose as much as 8.5 basis points. That means the cost of insuring against corporate defaults in Europe just spiked. Investors are pricing in higher risk of default. Commodities. While gold surged, other commodities showed mixed results. The focus was clearly on safety, gold and currencies, rather than industrial metals or energy. This pattern is classic risk-off. This is what markets look like when investors are scared, stocks fall, gold rises, safe haven currencies strengthen, Credit risk increases. This is the recipe for a market crash. Now let me address the skeptics, because I know some people are thinking this is just a 1% to 2% move. Markets go up and down. This isn't a crash. You're being dramatic. Here's why that's wrong. Here's why this matters more than the percentage suggests. First, this happened overnight on a US holiday. American markets weren't even open. When markets reopened Tuesday, we could see the full impact. A 1% futures decline could easily become a 2% or 3% decline when actual trading resumes. Second, this is just the initial reaction. Markets are still processing what this means. As analysts dig deeper, as earnings estimates get revised, as the full trade implications become clear, the selling could accelerate. Third, this comes after European stocks just hit near record highs. According to verified analysis, the European benchmark has been overheating and is now the most overbought in 26 years. When an overbought market gets hit with negative news, the correction is always more severe than expected. Fourth, and this is critical, we don't know how this escalates. If Europe imposes $108 billion in retaliatory tariffs, what does the administration do next? Escalate further? Impose 25% tariffs immediately instead of waiting until June? Expand the tariff to more countries? And if the trade war spreads, if confidence collapses, if earnings get crushed, if GDP starts contracting, this 1% to 2% decline becomes the opening act of a much larger crash. Let me show you the specific sectors that got destroyed overnight, because the pain isn't evenly distributed. Some industries are facing catastrophic risk. Automakers. According to verified reports, auto shares led the European market losses. This makes sense. European automakers, German luxury brands, French manufacturers, British car companies, they all export heavily to the United States. A 10% to 25% tariff would make their cars significantly more expensive for American buyers. That destroys demand. That crushes earnings. Luxury goods. Luxury stocks took heavy losses. Again, this makes sense. High-end European brands sell luxury goods, watches, fashion, leather goods to wealthy Americans. Tariffs make those products more expensive. Wealthy Americans have alternatives. They can buy American luxury brands instead. European luxury companies lose market share. Industrials. Industrial companies with U.S. exposure got hit. These are companies that sell machinery, equipment, components to American manufacturers. Tariffs disrupt supply chains and raise costs. Financials. Banking and financial stocks fell as credit risk increased. If European companies face tariff barriers, their earnings fall. If earnings fall, default risk rises. If default risk rises, banks that lent to those companies face losses. Meanwhile, defense stocks surged. This is the tell. When geopolitical tensions rise, when alliances fracture, when trade wars threaten to become real wars, defense contractors benefit. The fact that defense stocks rallied while everything else crashed tells you how serious the situation is. Now let me connect this to precious metals, because this is where everything we've been discussing for weeks comes together. Gold just hit $4,673 per ounce, an all-time record high. Why? Because when confidence in the system collapses, when trade wars threaten growth, when currencies weaken, when debt levels are unsustainable, investors run to gold. Gold is the ultimate safe haven. It's what central banks buy. It's what institutional investors flee to when everything else is falling apart. And the fact that gold just broke to new all-time highs while stocks crash tells you exactly what the smart money thinks is coming. But here's what is even more important. If gold is surging because of confidence collapse and trade war fears, what does that mean for silver? Silver is gold's more volatile, more industrial, more explosive cousin. When gold moves 1%, silver typically moves 2%. When gold rallies on safe haven demand, silver rallies even harder because it benefits from both safe haven flows and industrial demand concerns. Think about it. If a trade war between the US and Europe disrupts supply chains, if tariffs make industrial production more expensive, if manufacturers start hoarding critical materials, what happens to silver demand? It explodes, because you can't manufacture electronics, solar panels, electric vehicles, or AI infrastructure without silver. And if tariffs and trade restrictions make silver harder to source, if export controls from major producing nations limit supply, if manufacturers panic buy to secure inventory, the price goes vertical. According to everything we've discussed in previous videos, silver is already in a 230 million ounce structural deficit. Exchange inventories are already down 70%. The physical market in Asia is already paying $130 per ounce, while Western paper markets trade at $70. The system is already breaking, and now you add trade war escalation, you add geopolitical risk, you add supply chain disruption, you add panic demand from industrial buyers. Silver doesn't just go to $100. It could go to $150, $200, maybe higher as the perfect storm of deficit, disruption, and panic converge. Let me show you the response from European leaders, because this matters. This tells you how serious this situation is. According to verified reports, the 8 targeted European countries issued a joint statement calling the tariff threat something that undermines transatlantic relations and risks a dangerous downward spiral. That language is significant. Undermines transatlantic relations. That means the foundation of the Western alliance is being shaken. Dangerous downward spiral. That means they see this escalating into something much worse. This wasn't a single country complaining. This was 8 nations, NATO allies, G7 members, some of the most important economies on Earth, speaking with one unified voice in opposition. And, according to reports, the European Union is already in talks to impose retaliatory tariffs on $108 billion worth of American goods. They're not backing down. They're preparing to fight back. This is how trade wars start. One country imposes tariffs, the other retaliates. The first country escalates. The second escalates further. And before you know it, you're in a full-blown economic war that destroys growth, crushes earnings, and triggers a global recession. Well, we've seen this movie before. The Smoot-Hawley Tariff Act of 1930 triggered a trade war that deepened the Great Depression. Global trade collapsed by 65% between 1929 and 1934. Unemployment soared. Economies contracted. The world economy didn't recover until after World War II. Is that where we're headed? I don't know, but the pattern is eerily similar. High debt, economic fragility, tariff escalation, retaliatory measures, collapsing confidence. Now let me address the Greenland issue specifically, because some people are asking, why Greenland? What's this really about? Here's the strategic importance of Greenland according to geopolitical analysts. Resources. Greenland has massive deposits of rare earth minerals critical for technology and defense. It has oil and gas reserves. It has potential mining wealth that could be worth trillions. Military. Greenland's location is strategically critical. It sits between North America and Europe. It provides access to Arctic shipping routes. It's important for missile defense and early warning systems. Geopolitics. As the Arctic ice melts due to climate change, new shipping routes and resource access opens up. Greenland becomes more valuable. Major powers, America, Russia, China, are all competing for Arctic influence. So the administration's interest in Greenland isn't random, it's strategic. But threatening tariffs on 8 allies to force them to accept American territorial expansion, that's crossing a line. That's using economic weapons for territorial conquest. And that terrifies markets because it means the rules-based international order is breaking down. If America can threaten allies with economic destruction to get what it wants, what does that mean for international trade? What does it mean for alliances? What does it mean for global stability? Markets are pricing in the answer, chaos. Let me show you what happens next in the near term, because we have clear catalysts coming this week. Tuesday, January 20th, American markets reopen after the Martin Luther King Jr. holiday. We'll see the full reaction to the tariff threat. Futures are already down 1.1% to 1.4%. Will that expand when actual trading begins? Will selling accelerate? Will panic set in? Wednesday, January 21st. According to reports, the president is scheduled to address the World Economic Forum in Davos, Switzerland. What will he say about the tariffs? Will he double down? Will he escalate? Will he back off? Markets will be watching every word. How will this affect your European sales? Will you raise prices? Will you move production? How bad is this going to get? February 1st, this is when the 10% tariff is supposed to take effect. Will it actually happen, or is this a negotiating tactic? If the tariff actually gets implemented, markets will crash harder. But the uncertainty between now and then will create massive volatility. According to the verified data we discussed earlier, gauges of European credit risk rose significantly. The iTraxx crossover index of junk-rated credit default swaps spiked 8.5 basis points. That means institutional investors are buying protection against European corporate defaults. According to reports, bond issuance in Europe slowed dramatically. This was the quietest Monday for European debt issuance since December 2024. According to currency data, the dollar weakened while the Swiss franc surged. That means capital is flowing out of dollars and into francs. According to the gold market, institutional buying pushed prices to all-time record highs above 4,773. Central banks are buying. Sovereign wealth funds are buying. Major investment firms are buying. They're positioning for worse to come. This is what smart money looks like when it's scared. They're buying protection. They're delaying commitments. They're fleeing to safety. They're accumulating gold. And they're doing it all before the real panic begins. Let me connect this to the dollar collapse thesis we've been discussing. Because this Greenland tariff situation accelerates every concern about dollar dominance. According to analysis from a major investment bank, the dollar could weaken further on tariff threats. Why? Because if America is using tariffs as a weapon against allies, if the administration is willing to damage relationships for territorial expansion, if the rules-based order is breaking down, why would foreign countries continue holding dollars? The dollar's status as reserve currency is based on trust. Trust that America will honor its commitments. Trust that the system is stable. Trust that alliances matter. Trust that economic relationships are win-win, not zero-sum. But threatening allies with economic warfare over Greenland dipped 0.3% overnight. That might not sound like much, but for the world's reserve currency to weaken while risk-off sentiment dominates, that's unusual. The fact that it's weakening now tells you confidence is cracking. A 10% tariff on imports from 8 European countries means European goods become 10% more expensive for American consumers. More expensive, Swedish furniture, and it's not just finished consumer goods. According to economic analysis, tariffs are inflationary. They raise prices across the economy. And if inflation picks up again, what does the Federal Reserve do? Raise interest rates? But if they raise rates while the economy is weakening due to trade war that triggers a recession, lower rates to support growth? But if they cut rates while inflation is rising, that destroys the currency and makes inflation worse. The Fed is trapped. Interest rate policy that can't help because any move makes something worse. According to verified analysis, the European Stocks 600 was the most overbought in 26 years before this tariff threat hit. 26 years. That means European stocks had rallied so far, so fast, that they were more extended than at any point since 2000, right before the dot-com crash. When an overbought market gets hit with negative news, the correction is always more violent. Overbought conditions mean there's no one left to buy. Everyone who wants to own stocks already owns them. The fact that European stocks were the most overbought in 26 years and just got hit with a major trade war escalation, that's a recipe for a crash. We could easily see 5%, 7%, 10% declines in European markets if this continues. And now the catalyst arrives that accelerates the selling. 1930, Smoot-Hawley. Tariff. Trade war triggers. Great Depression, global trade collapses 65%. 1987, Black Monday. Stock market crashes 22% in a single day. 2008, financial crisis. Lehman Brothers bankruptcy triggers global market collapse. 2018, trade war volatility. Administration announces tariffs on China. Markets become extremely volatile. S&P 500 falls 20% from peak. We're seeing elements of all these scenarios right now. Trade war escalation like 1930 and 2018. Overbought markets vulnerable to crashes like 1987. High leverage and credit risk like 2008. And the catalyst, Greenland tariffs, just arrived. And based on the fundamental backdrop, high debt, fiscal deficits, structural silver shortage, dollar vulnerability, geopolitical risk, I lean toward crash. Now let me tell you exactly what you need to do right now to protect yourself. But if you're 100% equities, that's dangerous. The risk reward is terrible right now. Markets are overbought. Trade war is escalating. Fundamentals are weak. If you own German automakers, French luxury brands, British pharmaceuticals, understand that these companies face direct headwinds. Their earnings could get crushed. Increase safe haven allocation. Gold just hit all-time highs for a reason. Consider allocating 10% to 20% of your portfolio to physical gold or gold ETFs. The structural deficit, the vault depletion, the industrial demand, the supply restrictions, everything points to explosive upside. And if markets crash, if investors flood into precious metals, in a systemic crisis, when markets are crashing and credit is freezing, paper assets become questionable. Can you redeem your ETF shares for physical metal? Can you access your brokerage account if systems fail? Physical gold and silver in your possession eliminate counterparty risk. Markets are going to swing wildly in the coming weeks. If you're positioned correctly, reduced equity exposure, increased safe havens, physical metals, you'll be fine. Let me give you one final piece of evidence that this matters more than most people realize. According to verified reports, this is being described as the most forceful rebuke from European allies in recent memory. The joint statement from 8 countries, the unified opposition, and if the transatlantic alliance fractures, if NATO cohesion weakens, if the rules-based order breaks down, the entire post-World War II international system is at risk. That system has provided 80 years of relative stability. It's enabled global trade. It's supported dollar dominance. It's created the framework for economic growth. But if that system is breaking down, if alliances are fracturing, if economic warfare becomes the norm, we're entering a fundamentally different and more dangerous world. And in that world, stocks become riskier, currencies become unstable, debt becomes unsustainable, and hard assets, gold, silver, commodities, real estate, become the only reliable stores of value. Here's my final message to you. The futures collapse overnight isn't just about a 1% to 2% move in stock prices. It's about what that move represents. It's about confidence breaking. Gold didn't hit $4,173 by accident. It hit that level because the smart money sees what's coming. European stocks didn't crash by accident. They crashed because earnings are at risk. The dollar didn't weaken by accident. It weakened because confidence is eroding. And this is happening in the context of record debt, structural deficits, depleted vault inventories, and a silver market that's already breaking. This is the metal guy from Currency Archive. European markets fell hard, Germany down 1.3%. The president speaks at Davos Wednesday. The tariff is supposed to take effect February 1st, and nobody knows how this escalates from here. If you don't own precious metals, buy them now, before confidence collapses entirely. This is the metal guy, before markets reopen. Go, 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 go.